Hey, it's Richard with Matthews Wealth Management. We're going to be talking about REITs today. REITs stands for Real Estate Investment Trusts, and they're specifically attractive for investors looking for yield and dividends. They tend to pay higher dividends than most other types of investments, and we're going to talk about why, and we're going to talk about the things to pay attention to make sure that it's not too good to be true. So let's jump right in. Real estate investment trusts, the reason why you'll see their yields be as high as they are relative to other stocks and so for other corporations is because, number one, they don't pay the corporate tax rate, the 21% that everybody else is paying before looking at doing something with their earnings. The second piece of it is that they're required to be a real estate investment trust. They have to be paying more than 90% of their income as dividends to the shareholders. And so that comes with it a couple of other tax issues down the road that we're going to talk about, but it just boosts the amount of money that's coming back to the investors. So when we're looking at that 90%, that's a requirement for income. There's another factor, or a lot of factors actually, but the main thing that we need to look at to judge a REIT and its earnings and dividend payment, etc., is what we call funds from operations. So as a company brings in lease payments and rent and mortgages, if they're buying debt, if they're doing upkeep and charging penalties and fees, etc., all of those different sources of income come into the real estate investment trust. So that's funds from operation. Now, from that revenue, there are expenses, obviously. You're paying a manager, a property manager in a lot of cases. You're paying accounting firms, attorneys, and so forth. But you're also, one of the things that makes this attractive for a lot of people is that it can pay out depreciation. So if you've gotten into the world of real estate, one of the things that a lot of tax preparers and tax advisors will do is start to depreciate the holding. And so what that allows is you to offset the earnings with some depreciation to minimize current taxes. So nothing in this video is meant to be considered tax advice. Always speak with your tax advisor about what the IRS could hold you to in dealing with all of this. But the gist of how real estate works and why this is attractive is one of the things that they'll do is they'll pay out a dividend to lower cost basis, right? Because that lowers the amount of income, more of the income comes out. The flip side of why that might be difficult down the road is as you lower your cost basis, once it comes time to sell, you're going to have a larger gain to pay the taxes on. Now, the good news out of this is that you would be paying a long-term capital gains rate, which usually is less than income tax rate. But what we're really discussing here in terms of understanding how this yield is applied is at what level you're going to be taxed. So a lot of dividends work as long-term capital gains. A lot of them work as income tax, and down the road it's going to adjust for appreciation and depreciation. So in some cases inside of a REIT, let's say it's a healthcare REIT and they've bought a assisted living facility, and then they get enough demand and they want to sell it. So what they'll do is they'll sell it, there'll be a gain realized, and then they'll pay that out as income. Well, traditionally that would have been a long-term capital gain tax rate on that difference, but because they're paying it out as a dividend, you're paying a higher tax rate as income. So there are pluses and minuses inside of these, and that's why it's important to understand the types of properties, what the manager of these trusts wants to do. Like, what is the purpose? Are they trying to maximize current income? Are they trying to look at long-term capital appreciation options, and so forth? So what we're going to do is we're going to look at 5 different holdings here. These are REITs that exist, and these numbers, I believe most of these are end of 2018 reports. There might be a 2019 thrown in here, so bear with me if it's not exact, as you're fact-checking me, of course. But what we're going to do is just kind of cover these and look at all of these columns and what they mean, so that we can accurately compare these 5. So the first one we have here is Simon Property. They work in malls. Obviously, if you've been to any local mall, it's probably owned by Simon. But Host Hotels is obvious. Annaly Capital does mortgages and other financial instruments in the real estate world. Public Storage, everybody's seen the public storage facilities. And then Digital Realty. This is actually getting a little bit more popular. A lot of these data centers for like Amazon and so forth are just these huge amounts of data being stored, and it's refrigerated, it's controlled as far as security and so forth, but there's money to be made there as we're expanding our data infrastructure. So let's look at these five here. Simon Property, Host, 4.6, 4.2. Then we got Public Storage and Digital, 3.7, 3.6. Those are great dividends, but you got this thing that pops out in the middle at 11.8% yield. That is huge, right? And I'm sure you've seen these. Like if you're following Motley Fool or just doing some research on dividend stocks, you'll come across these huge yields, and then you start to ask, well, why? Why is this 11.8? Because that's a no-brainer, right? If all things are the same, apples to apples, you'd put the majority of your REIT investments into Annaly Capital. So let's look at exactly what dictates that 11.8 versus these 3s and 4s. So the first thing we'll look at is just what is the dividend, okay? So the dividend is a dollar amount that each of these companies specifies. They can pay annually, quarterly, semi-annually, monthly. They're all very different. I think all of these happen to be quarterly, but this is a dollar amount on an annual basis. So if you had one share of Annaly Capital, you would have $1.20 paid to you at the end of the year, which doesn't sound like much, but obviously it's a low cost stock, so it's giving a high percentage of itself back as a dividend. 85 cents here, I think our biggest one, $8 a year per share for Public Storage. So not huge dollars that we're talking about, but you multiply that by the amount of shares that you own, and that's where you're getting some decent income, right? And that's where we calculate the yield. So let's talk about what this dividend actually represents. So we covered all the different ways, talking about expenses, appreciation, depreciation, passing through that income, and how that's actually going to be characterized to the IRS is when we start talking about an ordinary dividend or a qualified dividend or something that works with Section 199A, and there's a new thing this year that we need to pay attention to, actually from 2018 is when that went into effect, Section 199A. And then what I find to be the most eye-opening is return of capital, okay? So let's just jump through and talk about what those are and compare the five examples that we have here. So the ordinary dividend, you'll see, is just traditionally what you would expect as a dividend payment, right? So ordinary dividend, however, does not count as a qualified dividend. So here's the difference. A qualified dividend is what, let's say, Lowe's or Duke Energy is paying. It's part of an investment into the ownership of a company, and therefore the amount of proceeds that comes out, which has been subject to corporate tax, is now going to be paid out to shareholders. Therefore, it is counted as a qualified dividend, meaning long-term capital gains. So a flat 15%, or in some cases 0% tax on that one. The ordinary side is ordinary to a REIT, okay? So that's actually a bad thing. That means we're getting into the world of taxable, right? On income tax as opposed to long-term capital gains. So income tax is 10, 12, 22, 24, etc. on the tax bracket. So it gets up higher than the 0 or the 15 that we would normally see for capital gains. So now we get to 199A, and this was something that came out in the new tax breaks, the Trump administration tax breaks that came out. Section 199A is actually very important for business owners. So if you're a business owner client, you already know what I'm talking about. But for people that are investing into a real estate investment trust, this counts as pass-through income that you can use as a qualified business deduction. So you're not in business, right, of managing these properties, but you kind of are. So what it allows you to do is to take this amount of the dividend and put it as a 20% deduction off of your adjusted gross income, which is awesome. So for business owners, we'll take, unless we're in a services industry or a doctor or an attorney or something, that gets a little technical there. So again, consult your tax advisor. But depending on what your line of work is, will depend on whether you can just take 20% of your income and deduct it. That's what Section 199A is about. So in these cases, we have a pretty good amount. And that was a big boost for the REIT industry back in 2017, going effective 2018. So, and then lastly, return of capital, which is has nothing to do with being taxed, right? So we were talking about whether we were dealing with long-term capital gains, ordinary income, that's the easy way to remember ordinary, or deductible before ordinary income, right? So the last one has nothing to do with taxes. This is you getting your own money back. So if you think of like an immediate annuity, you give an insurance company $100,000 and then they start paying you, $438 a month, that's your own money pretty much, with a little bit of interest coming back, right? So that's a bad example of how to invest. You're not actually making money, you're getting your own money back in a controlled way. So what we do here is we're getting money back. All right, now this isn't necessarily appreciation from buying and selling and flipping real estate and making money. This is, hey, we want to pay out a big dividend return. In exchange, we're going to be shrinking our holdings, right? So if we own 20 different hotels for host hotels and we're selling one hotel just to pay our dividend, that becomes a return of capital. So how can you maintain your dividend rate if you're shrinking your invested amount? That's where these things get tricky. So that's why we really want to pay attention to the return of capital. So real quick, Simon, we've got the $7.90, $7.60 of it's ordinary. Some of it's going to be treated as long-term capital gains. That's actually really cool. You don't see that very often. $7.13 gets to be counted as Section 199A. And then we've got 30 cents of that $7.90, or 3.8% of it, being returned, selling off some assets, and here's your money back. So that's not bad, it's not good, it's kind of what it is. So host hotels, 85 cents. Most of that's going to be ordinary. None of it gets counted as long-term capital gains. Same number on 199. Very, very, very tiny amount of return of capital, 0.3%. That's awesome. And then we get to the big one, the 11.8% yield. That's only $1.20. Well, 0.73 or 73.1 cents is going to be considered ordinary. Same thing, it applies to the 199, but 39% of that dividend is you getting your money back. So that is a red flag. That's a problem when you're getting such a large portion of your investment back, not being taxed on it. Obviously, it's not being used to generate more income or to buy something that will appreciate. So that might be a REIT that's kind of starting to close down, and that's why you start to see these yields take off. Okay, so you got to be real careful when you see something that looks too good to be true. Look into it. It doesn't necessarily mean that it is, but this is something that would keep me away from investing in something like that. So then public storage, $8. We got another qualified. That's pretty cool. We've got 0.2% as being return of capital. So again, that's very good. We want to keep that as low as possible. And then the last one, the data centers, we start to see another issue. We don't have the qualified. 78.5 cents of our $4 almost is just our capital back. So again, that would definitely keep me away from looking at that right now, unless there's a great reason. I mean, that's a reason to listen to shareholder meetings, read all the thick documents that come in the mail for the semi-annual and annual reports. You can find out if there's a legitimate reason to have a large return of capital, but otherwise it's worth looking beyond this column. If this column is making your decisions, you could be making bad decisions. So hopefully that's helpful to understand how the dividends inside of REITs work, why they're higher, how they're affected in different tax areas. Again, I'm not a tax advisor. Consult your tax advisor to see how they'll apply to you, but this is just a general breakdown. So hope that's helpful, and invest in real estate. It's a good asset class, but make sure you know what you're doing. Come back and see us next time.